Okay, hello everyone. I'm Janice and I'm from the director of the Low Income Taxpayer Clinic. And I want to thank you very much for joining us today. We're very lucky to have Dan Heller as our speaker today. And he will tell you a little bit more about himself in a moment. I just wanted to please invite everyone to follow us on social media. We have MBLS is 40 years old now. And so to celebrate that, we have a new logo. This is our new look. So, Dan, if you'll please advance the slide. Great. MBLS is always looking for volunteers. You know, we do have some pro bono cases, and this particular topic, even though we don't see it a lot at MBLS, we do see it. So definitely it's something that you can apply to a case. And so please let me know if you're interested in taking a case with this type of issue. If you're looking for a pro bono case, because you can't sleep at night and you want to help somebody, you would go to our Pro Bono Portal, which is that little circled area there on our website. And if you'll advance the slide, please. And I do want to share with you that MBLS is focusing on looking at our work in a race equity context. You know, there certainly is a very unique time period, and it's also bringing to light a lot of things that we had perhaps weren't as aware of before. You know, in terms of how institutional systems are perpetuating inequities, and even in tax, you know, even though the tax code appears neutral on its face, you know, there can be some issues going on there. And it's important for us to understand that. So as we're working with our clients and trying to understand the additional obstacles or hurdles that they're facing. Next slide, please. So we do want to encourage our volunteers to think of these things as they're approaching their clients, and also really trying to value the client's experience and understanding their past experience of the communities of color within the system, and approaching these clients with a non-judgmental attitude by giving them additional space to ask questions and actively listening to their concerns. Next slide, please. So again, if you're interested in taking a case, please check out the Pro Bono Portal. Our cases are categorized according to the line at the top there. Tax is the little blue box, but it certainly is. It's a small box, but it's certainly, I think, the most important box. So definitely, please look there. If you're not already a volunteer, we do encourage you to become a volunteer so that you can apply this great information to a case. Next slide, please. So as a volunteer, not only do you get access to these great tax trainings, but we also have recordings of other trainings in other areas of law. And it's a great way to network and meet people as a volunteer and get to get exposed to trainings and such as these. And this training will be recorded. Dan has graciously allowed us to record the training, and we'll be posting this training and his slides on our website as well, which will be available to all of the volunteers. Next slide, please. So if you're not already an MBLS volunteer, we do encourage you to sign up today. And there's the link there. Thank you so much. And I think that's it then. Next slide, please. Great. All right. I'm going to turn it over to Dan and let him start talking. Thank you.
All right. Thank you for the introduction, Janice. And, thank you for having me here today. So my name is Dan. Good afternoon, everyone. Today's presentation is called How to Settle the TFRP Devil. It's an introduction to the trust fund recovery penalty. And I'm going to, in the next hour or so, discuss the trust fund recovery penalty, what that is, what it means as far as exposure for clients and ways to defend against it. The topic can be a little dry on its face, so the way we're going to do the presentation today is through a story I've created, where in this story, you, the listener, are going to be the attorney, and I have some fictional characters for a client and a business. And again, through the narrative, we're going to walk through this area of tax law. So this is my law and order disclaimer. The following story is fictional, does not depict any actual person or event. This is the less exciting legal disclaimer. Basically, everything in the slides today is going to be fictionalized. You're going to see documents I've created, tax returns, IRS notices, any kind of information, social security numbers, EINs, addresses, IRS employees' names, everything is made up. But you're going to see through this presentation that the information in those documents is going to be consistently used throughout the course of the narrative and the story. Okay, so that aside, now getting into it. So like I said, this is going to be a story. Let me just make a small adjustment to my screen. All right, so prologue. Once upon a time, John P. Bentley was a receptionist, made a moderate salary, and he enjoyed his job. He worked for a small 3-person company called Rainforest Delivery Incorporated. Rainforest was owned and operated by its president, Rich Worthington. After John worked at Rainforest for a few years, thought the company was doing great and everything was going well. That's until he received a letter from the IRS. So John received this letter 3164A. Like I said, this letter has been totally made up. Nothing, names, phone numbers, everything's fictionalized. But this is the type of letter you'll see when the IRS is investigating someone for the trust fund recovery penalty. Now we're going to get into what that means. We're going to get into the specifics and the nuances, but this is just to lay some groundwork. I want to put you in the shoes right now of John Bentley, who got this notice and just doesn't know what it means. But it's a lot. You can see that your employer, Rainforest Delivery Inc., owes business employment taxes. You might be personally liable. It's from an IRS revenue officer. And there's a lot of numbers on page 4, which can be very confusing to somebody who doesn't have any training in this area. So suffice to say, when John received this letter from the IRS, he was not too thrilled. So what now? So you have John, is confused and very scared, rightfully so. Doesn't understand what this letter means. Doesn't know what could happen to him. So he did what most prudent taxpayers are going to do in this situation and starts frantically Googling for a local lawyer. So he found you. And this is where the story now begins. So for the remainder of this webinar, as I mentioned, you are now John's lawyer. And we are going to guide John through his trust fund recovery penalty experience. So chapter 1, what is the trust fund recovery penalty? So John has a lot of questions during your initial meeting. He wants to know what trust fund taxes are. He wants to know what the penalty is. He wants to know if he's going to be personally liable. He wants to know what's going to happen. So the trust fund recovery penalty, or TFRP, is the personal assessment of a business's payroll taxes that were withheld from its employees, but not remitted to the United States. So we'll go into more details of the presentation, but the short of it is, when the business issues its employees its wages, their W-2 wages, there's money withheld from those checks for taxes. And when those payments withheld from those tax payments withheld from those wages aren't turned over to the government, that is where the trust fund recovery penalty can potentially be assessed against individuals. The statutory authority is Internal Revenue Code 6672 and 7501, which collectively allow the IRS to pierce the corporate veil. I guess before we get into some of the now details about the trust fund recovery penalty, just as a quick housekeeping matter, during the course of this presentation, I'm going to be citing 3 sources of authority. So the Internal Revenue Code, or IRC, that's chapter 26 of the United States Code. That's primary source of authority. There's a couple of cases I'll cite throughout this, which again, just when we get into a little bit of the minutia of the criteria for the assessment. And then you're going to see a lot of IRM, which is the Internal Revenue Manual. That is back on track. So John had a lot of questions about the trust fund recovery penalty. And so we've the Internal Revenue Code, the case law, and the Internal Revenue Manual is the sources of authority. Internal Revenue Manual, like I mentioned, is IRS guidance, its procedures, its protocols. It's not binding authority, it's not the law, and it doesn't trump cases or the statutes. But for administrative proceedings, it's good authority, and the IRS, if they're going to try to do something inconsistent with the manual, they need to defend what authority allows them to do that. So for the TFRP and things we're going to discuss today, the manual is a good place to look for authority. Get this back on slideshow mode. All right. Okay, so trust fund recovery penalty. Now that we know very generally what it is, we're going to go into the nuances of how it's actually calculated. And basically by looking at a Form 941, which was an employer's quarterly federal tax return, we're going to walk through which taxes are reported and which have the potential of being individually assessed against someone associated with the business. And generally, it's going to be a combination of federal income tax, Social Security tax, and Medicare tax. So this is like I mentioned, I know it's signed, everything's fictitious, it's a fake signature, it's a fake tax return. But this is the tax return for the second quarter of 2018. Now, when John received the notice saying that there was an investigation, this was the quarter that was being reviewed. So you can see at the top again, rainforest delivery, top right, it's the second quarter from 2018, some demographic information, but the key information is really on page 1. So line 1, 3 employees. There's some relevance there we'll get to later. Line 2 is the total wages for that quarter. In this case, a little over $30,000. And then lines 3 and down are going to be most pertinent for the trust fund recovery penalty. So in this situation, for those 3 employees for this quarter, on line 3, the total federal income tax withheld was $2,834. That is something each employee elects as far as number of exemptions they take, and the more exemptions they take, the less is withheld. But again, that's one item that constitutes the trust fund recovery penalty. The other items I'd mentioned, Social Security and Medicare, or collectively the FICA taxes. So you'll see line 5A is Social Security wages, same as the line 2 total wages, a little over $30,000. And then there's the percentage here. So it's 0.124. Next slide, I think we get into a little more detail about what that means for the trust fund recovery exposure. But basically, for that 0.124 for Social Security wages, and then for Medicare, it's 0.029. That percentage is a combination of what the employee has withheld from wages and what the employer matches. So the relevance there is going to be the matching part from the employer is not a trust fund tax, and that's not going to be personally assessed against anybody. But that half of those percentages for each type of tax are the employee's withheld portion, which are part of the trust fund recovery penalty. So in this situation, if you go through the total FICA taxes, you have $45.93, which is on line 5E. You add that to the federal income tax withheld, which is total $7,428. That's the total tax reported on the Form 941. And so in a perfect world, line 12 is the total, line 13 should be total deposits would match that. Well, here we're in a situation where the business for this quarter made no federal tax deposits, so the total amount is owed by the business. Next few slides, we're going to get into the relevance of personal exposure, but just know now, so we're at the second quarter of 2018, and the business owes a little under $7,500. Page 2 of the 941, not a lot of pertinent information for the TFRP, except when you go down to the bottom of part 5, you're going to see this was signed on July 5th, 2018. It's signed and dated by the president, Rich Worthington. And we'll get into the relevance of that in a few slides. Okay, so now we're going to get into the most exciting part of the story, which is the arithmetic and the math portion. So given that return of those numbers, we're going to walk through how to determine what the extent of personal exposure is, which again is the trust fund recovery penalty. So in this case, like I mentioned, it's the second quarter of 2018, Form 941. Line 3, the federal income tax withheld was $2,834.64. Line 5A, Social Security tax was total for the quarter was $3,722.82. Like I mentioned, half of that is for the employer matching and half is the employee withheld. The actual tax rate is 6.2%, but 6.2 for both employee and employer. So for the trust fund portion of that, it's half, which is the employee portion. And the same type of thing with Medicare tax. So total corporate Medicare for that quarter was $870.66. Tax rate collectively, that's 2.9, but it's actually 1.45 for the employer and for the employee. So half of the total 941 Medicare is potentially included in the TFRP, if not paid. So now we have Federal income tax withheld, $2,834.64. Total Social Security tax, $3,722.82, divided by 2 to only account for the employee, plus total Medicare of $870.66, again divided by 2 to only account for the employee, gives us a grand total of $5,131.38. If we go back to the initial slide, you'll see that's consistent with when John was informed there could be a problem. That was the number the IRS gave that could be the potential TFRP portion. And so moving forward now, we know that John's personal exposure is $5,131.38. So knowing that, the next question would be, who can be assessed the trust fund recovery penalty? And there's 2 general broad criteria. And we're going to get into a little bit of the nuances soon, but we're looking at responsibility and we're looking at willfulness and knowledge. So in this Internal Revenue Manual, section 8.25.1.3 lists the pertinent criteria for the TFRP assessment under Internal Revenue Code 6672. So generally speaking, the TFRP may be asserted against any person responsible for collecting, accounting for, and paying over trust fund tax who willfully fails to collect such tax, or fails to truthfully account for and pay over such tax, or willfully attempts in any manner to evade or defeat any such tax or the payment thereof. So very generally, what the IRS is looking for is a responsible person who knew the taxes weren't being paid and made the decision not to pay those taxes. Again, we're going to break down responsibility, we're going to break down willfulness and knowledge, but ultimately you need to be a role in the business where you could have paid the taxes based on whatever position you had, and you chose not to. And it's much more in depth than that, but just that's a general framework to keep in the back of your mind. Okay, so now we're going to go down each of those individual criteria, starting with responsibility. And here we're looking at the Internal Revenue Manual section 8.2.8.25.1.3.1. And just as an aside, all the manual provisions are online. You can Google them and it's full availability to the public. Okay, so the definition of a responsible person, again, in the framework of a trust fund recovery penalty, is an individual who has the duty to perform or the power to direct the act of collecting, accounting for, or paying over trust fund taxes. So again, if you're responsible in the company, if your job is to take care of financial matters, if you are responsible for tax matters, if you decide what bills get paid, when to pay them, priority of payments, general company financial policy, these are all going to lead toward a determination of responsibility. So a couple of cases in the Fourth Circuit that give a little more detail about responsibility. The O'Connor case is relevant in that it states that title alone doesn't establish responsibility. So what you'll see frequently with the IRS doing a trust fund recovery penalty investigation is they always start by looking at the president or the owner of the company. That's not going to be enough to establish responsibility, though. Just because you're the president doesn't mean that you were responsible. It's possible that the company structure is such that another party has that legal responsibility, and that is not the president or whoever the IRS might think is in charge through title. And then the Fourth Circuit, there's the Plett case, which gives a little more detail as the so the crucial inquiry is whether the person had the effective power to pay taxes. That is, whether he had the actual authority or ability in view of his status with the corporation to pay the taxes owed. So again, if you're looking at somebody who is the receptionist, and so they might have some access to the company records and books, but clearly in their job description and in their 20-year history of the company as a receptionist, they never had any corporate control, any financial decisions, any kind of check signing. That's going to be pretty clear they weren't responsible. And a lot of times responsibility can be a pretty clear-cut decision or determination in the company meets that criteria. But sometimes you get into a lot of muddy situations, which again, we'll get into a little more detail through this story, a couple of different scenarios that could complicate things. But that's generally responsibility. Were you the person who was supposed to take care of the taxes? And again, at its most basic. Once the IRS establishes responsibility, then the next level of a review is willfulness, or next criteria. So looking at Internal Revenue Manual, section 8.25.1.3.2. So the trust fund recovery penalty is a civil penalty. Again, this is not a crime. It's not a fraud. It's civil proceedings. And in the context of the TFRP, willfulness is defined as intentional, deliberate, voluntary, and knowing, as distinguished from accidental. So basically, you knew there was a tax issue, and you didn't address it, or you made sure the company did not address it, or you didn't take appropriate action on behalf of the company to address it, but knowing this issue existed. And we'll get into a little more nuance of what willfulness entails, but again, paying necessary business expenses while not paying the IRS, knowing there's an IRS problem, that's still willfulness. Again, there could be defenses for it, but you would be found willful if you made that decision. And I guess as an aside, and we'll get into this too, you can't have a willful blindness. So, just refusing to acknowledge the problem, refusing to look at mail, the IRS can impute knowledge and willfulness given the correct circumstances. So I alluded to some of these factors. Again, just some various details in the manual about considerations when determining if willfulness exists for a trust fund recovery penalty. So again, this is talking about a responsible party. This is assuming the IRS has established responsibility. So whether that responsible person had knowledge of a pattern of noncompliance at the time the delinquencies were accruing. Basically what this means is, in this case, we're dealing with one quarter. So hypothetically, if the last 4 quarters, there were unpaid employment taxes that John knew about, and he was going to argue he had no idea this specific quarter was a problem, the IRS could look at that history and the knowledge of the history as a factor in favor of willfulness. Another consideration is whether the responsible person had received prior IRS notices indicating that employment tax returns have not been filed or are inaccurate, or employment taxes have not been paid. Again, this is really, you have to read your IRS mail, and refusing to open the IRS mail is not going to be a defense to willfulness. Another consideration is the actions that the responsible party have taken to ensure the tax obligations have been met after becoming aware of the tax delinquencies. So once you know there's a problem, did you decide to prioritize IRS payments? Did you stop issuing payroll? What did you do to ensure that those back taxes were paid as quickly as possible and no new taxes incurred? If you didn't take any corrective action, that's going to be a factor in favor of willfulness. There are other issues too we're not going to get into today about if you know there's a problem and then there's acts or resources the business has subsequently, whether or not those could be folded into an IRS claim. But again, I think for today, we're not going to really touch on any of that. And finally, so whether there was fraud or deception used to conceal the non-payment of tax from detection by the responsible person. So this is actually a favor that would be against willfulness. And a typical fact pattern you would see here is, let's say the president of the company meets the responsibility criteria, and he or she is actively involved in the business's operations and takes all reasonable efforts to ensure tax compliance. But you have an employee, could be a treasurer or anybody with a tax responsibility, who was sending fraudulent documents to the president to show there was no problem, or was destroying IRS mail, and the president didn't become aware of this issue until well after the fact. If you could prove that the president's failure to act and know about the problem was due to this fraud, that would be a strong defense against willfulness. And if the government can't prove willfulness, they can assess the trust fund recovery penalty against the president or whoever this individual might be. Okay, so we've covered very broadly the idea of what the trust fund recovery penalty entails and the statutory criteria for assessment. We've given John all that information. He now understands what could be lingering. And so now we are going to return to our story about the next steps. So you've had your initial meeting with John, you're talking to him, you've educated him about the TFRP. And just keep in mind, so the trust fund recovery penalty, it's not just one individual the IRS is looking for. And frankly, the more individuals they can assess for the same period, it's joined several liabilities. So the more ways the IRS can potentially collect the debt on top of the business still owing the debt. And so what happens is, just hypothetically, if 3 people were assessed the trust fund recovery penalty for the same period, if anybody makes a payment toward that TFRP, or the business makes a payment toward that TFRP, everybody gets credit for that payment. So there's not a risk that if 4 different individuals and entities are assessed, the government's not going to get paid back 4 times. The IRS internally keeps track to make sure that that credit is shared among anybody who has that assessment. Okay, so in order for the IRS to determine who meets the statutory criteria, it interviews any individuals it thinks might be responsible and willful. And there's a form, it's called Form 4180, which is the report of interview with individual relative to trust fund recovery penalty or personal liability for excise taxes. We're going to go through that form in detail next. This form has been used for the IRS for several years. And typically during the TFRP interviews, they rarely go outside of this form. So what you're going to do as John's attorney now is conduct a mock interview following this form to determine the extent of John's TFRP exposure. Okay, so it's a 4-page form, and here's pages 1 and 2 of the form 4180. A lot of demographic information that, again, section 1 is just the who's being interviewed. Section 2 is responsibilities, and section 5 is knowledge and willfulness. And so you can start seeing how it's coming together now. That's the criteria are being reviewed to determine liability. So we'll go through again some of the key questions that are going to be asked from a client during this process, but just generally keep in mind the questions are limited to the period at issue. So here, all the answers are from the second quarter of 2018. Before and after are not pertinent for this 4180 interview. Again, those are the things the IRS might consider, but this interview is limited to those periods. So here, again, John is the interviewee. We have the second quarter of 2018 for rainforest. Section 2, responsibility. It's a series of questions that helps the IRS determine whether John, in his role in the company as a receptionist, is going to be responsible. So we have, did he determine the financial policy for the business? Did he direct or authorize payments of bills or creditors? Did he prepare, review, sign, or authorize, transmit payroll tax returns? Did he have knowledge withheld taxes were not being paid? Did he authorize payroll? Did he authorize or make federal tax deposits? And was he involved in electronic tax payments or online banking? In this case, again, we'll go through John's answers soon, but none of these factors really apply to John. These are all something that the president of the business was responsible for in this case. Section 3 is just signatures. Section 4 is just the IRS trying to determine who, in addition to their interviewing, could be responsible. In this case, it's going to be the other position, be the president, which is Mr. Worthington, Rich Worthington, who was the president during the relevant time. And John would indicate that he could do all these things the IRS was asking if he could do. Going quickly to section 5. So now we're in knowledge and willfulness. These questions are soliciting information to determine what John knew about the tax issues, about the company's financial wherewithal, and when he knew it. Again, we can go through each of these, did you know that taxes were increasing during this time? Did you know if any other financial obligations were being met? Were a portion of the payrolls being met? There's a lot of questions about net corporate payroll. So net corporate payroll is effectively when the IRS or when an employer issues a check to an employee for salary that has all the deductions removed, and the employee gets that check, but none of those deductions actually, in this case, let's say the only deductions were withheld taxes. None of those withheld taxes actually get paid to the IRS. And that's, the whole premise of the trust fund recovery penalty. But that's something you want to be careful about admitting to, even if true. You tactfully in doing away with, you raise your defenses, but just to be careful, because once you have certain admissions about not having paid those federal taxes when you knew or had an obligation to do so, that is an admission that could be used outside of a civil proceeding if the government decides to pursue criminal tax charges. And the government's position, just basically, if you can't afford to pay the payroll taxes and the withholding taxes when it's time to issue payroll, the government's position is that the payroll should be held off until adequate money is there to pay the taxes as well. And a lot of times businesses have a hard decision to make, knowing that doing that, you could very well lose employees, but you're limiting your exposure for civil and criminal tax issues. Here, John's answer, knowledge. The only thing he knew is when he got that letter from the IRS well after the fact that there was that second quarter 2018 unpaid federal taxes, employment taxes. Page 2 or page 3, I'm sorry, a lot of this information is about third-party payer companies or payroll service providers. Nothing really pertinent here. Section 7 is about excise taxes, nothing here. Page 4 is basically write an additional statement, and we will get to that later about the value of that section. Okay, so with that form in mind, you're going to conduct the mock 4180 interview with John. You determined his exposure was minimal. Again, I mean, he didn't have any financial control of the company. He had no role in the taxes. He didn't even know there was a problem till well after the fact. He didn't prepare the return. He didn't sign the return. He was just a receptionist and no access to the business's financial records or corporate records. However, it can't be that straightforward. John did have check signing authority in the second quarter of 2018. He doesn't really remember how many checks he signed, but he does know, when Mr. Worthington, for his convenience, and when given explicit instructions to do so by Mr. Worthington, John would write checks wherever Mr. Worthington told him to do, and John could sign those checks when Mr. Worthington wasn't in the office. But John had no independent discretion about bill payments or check writing authority. It was all at Mr. Worthington's explicit instructions. Okay, so now we know John's potential exposure. John knows the lay of the land. So now we're contacting the revenue officer. In this case, it's Revenue Officer Vogue, who was on that initial letter we received. We just scheduled a Tfrp interview at our office. And so you inform John that he's going to need to be present at this interview, as the questions will be directed to him. John's responsible for answering these questions. You can't answer on John's behalf. However, you can certainly clarify things, and you can make sure the revenue officer understands and accurately reports John's answers, and make sure John gets all relevant facts into the record. And make sure, again, this process, the revenue officer should be professional and act appropriately. This should not be a hostile experience. Now, typically, these are done face-to-face. They can be done on the phone, and during COVID, they will be done on the phone for the foreseeable future, I suspect. Okay, so you scheduled an interview with the Tfrp with the revenue officer, and a few weeks later, the interview has occurred. So it began with you explaining John's role in the company. Again, you can give your opening, and again, it's all very informal, but you can explain, John's a receptionist. He didn't have any knowledge of what was going on. It wasn't his role in the company, et cetera, all the things we talked about. Hitting on the key points of willfulness and responsibility, at which point the revenue officer is going to just go through that 4180 form with John, effectively line by line. So the interview went as expected. The revenue officer focused on the fact that John had check signing authority. Revenue Officer Vogue got hung up on that during this interview. And what you didn't expect to have happened, but what did happen was the revenue officer came prepared with copies of bank statements and checks for the second quarter of 2018 that he had summoned from the bank. So Revenue Officer Vogue shows you and John at this interview meeting that of the 30 checks written during the quarter, John signed about half, which that certainly makes it a little more difficult for John, but it's not devastating at all and can certainly be explained away. So the revenue officer presented the checks, and you explained that John was instructed to sign every single one of those checks by Mr. Worthington, the company's president, at Mr. Worthington's explicit instructions. And you confirmed that John had no discretion to sign any of those checks without approval. And the revenue officer then asked if there was anything in writing to confirm this about these checks. And John confirmed that everything was done verbally from his boss, which more times than not in this situation, everything is verbal. I mean, every now and then you'll get an email from a boss who's out of the office or on vacation to cut a specific check, but typically the boss will call a check signer or receptionist, a manager, and spew off a series of checks that need to be paid. And you'll have that verbal authorization, which is okay, but in this context, a writing is always best. But when it doesn't exist, you play the hand you're dealt. Okay, so the Tfrp interview is pretty much over. And the revenue officer allowed you and John to review the 4180 before John is instructed to sign it. So at this point, you requested an opportunity to incorporate more details about John's check signing and restrictions and his limited role in the company's operations. Revenue Officer Vogue had no objection and just gave you page 4 to write whatever you wanted. So you took advantage of this and you took the opportunity to emphasize those facts in John's favor. Again, specifically now addressing the check issues, but also the other pertinent things you'd raised initially during your opening. Again, you want to get as much on this 4180 as you can. Just in the event that there is an assessment of the TFRP, you'll have this as something you can use in appeals and later down the road. So you write your statement on page 4, everything looks good. It's signed by John, it's signed by the revenue officer. The revenue officer tells you, he's still got to complete his investigation, which in this case is interviewing other potential liable individuals. And you should hear back when his investigation is complete. So all in all, it went well. You believed the revenue officer was receptive to your arguments. He understood that John based his role in the company didn't meet the criteria for the assessment of the TFRP, and you feel good about it. 30 days later, you received a notice that John would not be assessed a trust fund recovery penalty. Means John's off the hook. He has survived his encounter with the TFRP double and lived happily ever after. So we still have about 20 minutes today, so that's not where we end this story. We're going to do a couple alternate endings now to keep things a little more interesting. So let's see what happens if things went a little differently. So going back now, the interview's over and you're ready to hear back from the revenue officer. So again, all in all, the interview went well. You believe the revenue officer was receptive to John's arguments and understood based on his role, he's not going to be assessed, doesn't meet the criteria for the TFRP. 30 days later, you received a letter 1153 and a form 2751 proposed assessment of trust fund recovery penalty. So the IRS has revenue officers completed his investigation and decided that John should be personally liable for those debts. So of course you immediately call Revenue Officer Vogue to determine why he had these findings. And according to Revenue Officer Vogue, it's solely based on John's check signing authority and the signing half the checks. Everything else was considered, but he thought that was adequate to hold John personally liable. Again, you zealously advocated for John's best interest, explained that the statutory criteria require much more than that. But Revenue Officer Vogue told you he doesn't really care. The case is out of his hands. And he politely told you can take your dispute up with appeals by filing a protest if you so choose. So this is the proposed assessment form, the form 2751. Similar information to the other forms that the IRS has about the assessment. You can see it's Rainforest Delivery Inc., 941, second quarter of 2018. So now here you can see in that second to last column, the amount owed to the IRS is $11,176. That's the total corporate 941 liability for that quarter. And the reason it's so much higher than the $5,000 and change owed by John is or proposed to be owed by John, I should say, of the trust fund recovery penalty. That's a combination of the fact that it's only the half of the Social Security and Medicare, whereas again, the corporate is responsible for the full 941. But because these liabilities were not timely deposited through federal tax deposits, the corporation also has penalties. In this case, I believe there's a late filing because the return looks like it was filed after the deadline. And you also have federal tax deposit penalties, which we're not getting into today. Those do not assess against individuals, but it will significantly increase the corporate exposure. So you have the corporate owing over $11,000, trust fund recovery is $5,000, and a 60-day window to appeal for John before this liability is finalized. So you're going to appeal. It's an administrative appeal. It's called a protest in this setting, and it goes to IRS appeals. The details for what to include in the protest are in the 1153. There's different criteria for small and large cases, but the short of it is you want to raise the same issues you raised during the revenue officer's investigation, but you want to do a lot more legal analysis now. So you want to cite the statutes, the regs, pull the case law, develop the factual background. The more you can throw in this, the better. Find cases specific to your facts as best you can. And any facts you cite, supporting records, now's your time to start incorporating them into this filing. Because if the revenue officer in this case appears to have been wrong, you'll have a strong argument to have it overturned in appeals, which is going to be your next level of review. So you file the protest, you have the legal arguments, the factual assertions, the supporting records. A few months later, you receive a letter from IRS Appeals confirming that a teleconference has been scheduled to discuss your dispute about the TFRP. You inform John he doesn't have to attend this hearing. Typically, you wouldn't have your client at the appeal conference. It's not necessary. There's a time and a place for it, but I would defer to typically just not having that be the case. And it's, again, you'll have the factual record based on documents in the case history. So you have a teleconference with the settlement officer, which is your hearing. The settlement officer, seeing that the issue came down to check signing, questioned your ability to prove that John only signed checks when instructed to do so by Mr. Worthington, given that this was done verbally. So you're prepared to offer an affidavit from Mr. Worthington, as well as the business's bylaws, all of which confirm that only the president has financial decision-making authority. Settlement officer agreed to consider those documents, which you then provided. 45 days later, you received a determination from appeals overturning the proposed TFRP assessment. Now John's off the hook through a favorable appeals determination, and now he has survived his encounter with the TFRP devil and lived happily ever after. So once again, we still have about 15 minutes, so it's not where the story ends. Got one more alternate ending, just to go through ways this could play out. So what if the settlement officer upheld the proposed penalty? This news will not be well received by John. You're not going to want to hear it. It's frustrating. They're just not getting it right when you know the law is on your side. So luckily, you still have administrative remedies here before there's any kind of requirement to find yourself in court to dispute this. So the next step to contest an appeals determination upholding the TFRP is going to be by filing an administrative refund claim. So in order to file this claim, John first had to pay the withholding tax for one employee for the period in dispute, in this case, the second quarter of 2018. Now, because we're only dealing with one quarter here, it's a pretty straightforward jurisdictional requirement. We saw the 941. Again, the total liability is $5,200 for 3 employees. You would need some access to records to determine the lowest paid employee, which was, I would advise, paying their FICA and income withholding tax. If you don't have that information, John can pay his portion in, which he should now. It gets a little more complicated with multiple periods. And the reason is that this, typically for a refund claim, you have to pay the full amount in, but because trust fund recovery penalty is a divisible tax, meaning that it's made of multiple taxpayers, a cumulative liability. There's different jurisdictions have different criteria for multiple periods and the minimum that has to be paid. But again, because this is just a very general review of the trust fund recovery penalty, I'm doing one employee or in one quarter. I'm sorry. We're just looking at one employee for this quarter. Again, ideally the lowest paid employee, so you have to pay the least amount in. So let's say each employee was paid evenly. So it's about $1,800 per employee. John pays an $1,800, designates it as the employee he's going toward. And then once that payment is processed by the IRS, it's going to be credited toward this trust fund recovery penalty. John then files a refund claim using Form 843, claim for refund or request for abatement. Same arguments as before. Again, the record should be developed. You can almost take your appeal and prior filings and just reformat them a little into a refund claim. But it's an administrative claim gets filed, and the relief you're asking for is that the IRS refund the amount John just paid to get a jurisdiction into this case. But upon the issuance of that refund and determination that John's not liable for the TFRP, to abate the remaining liability. So if successful, John's case is resolved. He gets his money back that he just paid in. The remaining TFRP is not going to be against him. They'll abate it. And he's free to go live his life. However, if the administrative request is denied, you can still seek a refund in federal court. In this case, it's going to be a difficult decision to make if the whole liability is under $6,000. And we'll go through some other options, but entering federal court, I mean, there's a cost associated there, which you really have to sit down and have a frank conversation with your client. Is that their best remedy, given the potential exposure financially? So that's the very broad overview of John's story to get you a glimpse of the TFRP. Couple of final thoughts. So in this case, we had a small business 3 employees, relatively low quarterly payroll, and John's exposure, again, not an insignificant amount of money, but it also was under $6,000. In other situations where somebody in John's role is working for a company that has 100 employees, that notice could have been for $80,000. Or if this had happened for 3 quarters, it could have been $250,000. So the TFRP can really blindside some individuals thinking that, just working for a business, there's no personal exposure. And then when they get the letter from the IRS saying they're being investigated for, $200,000 tax liability, that can be terrifying, rightfully so. Also, just generally, our facts are pretty clear cut here. John didn't know about the issue and no reason to know, clearly had no way of addressing the issue. He was able to sign checks when his boss told him to, which in most companies, more than one person can sign checks, even a smaller company. In most cases, you're going to see it's much muddier. You might be dealing with somebody who's a president, who's an owner, who's a manager. And typically, you might not be able to have incredible arguments with willfulness and responsibility. But frankly, you only need to prevail on one of those criteria. And again, you shouldn't restrict your arguments to either or. But if the IRS can't establish responsibility and willfulness, your client wins. And you need to know going into this, in a perfect world, you'll present the case to the revenue officer and the assessment won't go forward. But the reality is that revenue officers' jobs are to collect tax debts, and they do that as aggressively as they can within the means they have. And like I mentioned earlier on, the more people that can be assessed, the more likelihood that debt gets repaid. So you really need to know your remedies administratively and otherwise. In this case, that's why I walked you through the initial investigation, the appeal, the refund, and the ability to go to court if necessary, which again, case-by-case basis. So what we talked about today was what to happen after the fact, or what should happen after the fact to defend a TFRP liability assessment. But if you have a client who wants to know how to avoid this exposure, you just really need to work backwards to suggest precautions. So here, check signing authority got John into a lot of trouble. The solution would be to have no check signing authority. But if you're in a position where you need to sign checks to do your job, then have multiple signers. One of them should be the person with authority, and the owner, the president. Another situation would be have checks in writing when you need to sign those checks. For every time there's a directive to sign a check. In this case, had John presented that might have made his life much less stressful earlier on. Employment agreements detailing the limited scope of an employee's work. All of these things, again, individually might not make a difference, but collectively can work to establish adequate facts to show that your client wasn't responsible for the trust fund recovery penalty that wasn't paid. So just as a couple of thoughts to wrap everything up here. So what if everything had failed as far as the fighting the TFRP assessment? So you exhausted all your remedies. You decided it's not worthwhile to go to court. It's just there's other ways to address this, but it doesn't seem terribly fair that John should be required. And let's just say John can't pay back $6,000. The IRS has 10 years to collect. Let's say with John's reasonable living expenses and the money he earns from this job, if he still has this company, maybe the company went under, that's just, it might as well be $100,000 for him. It's never going to happen. So there are other options. And I know MVLS has several good trainings and webinars about these things, but just to give you a very, very mile-high bird's eye overview, a couple of collection alternatives the IRS will consider. So you have the offer and compromise, which is basically a settlement with the IRS. And then the position would be if you can prove that within the time the IRS has to collect a debt, typically 10 years, your client would never be able to pay that debt back. The IRS should consider a settlement of less than the full liability. could be $100. Again, it's based very much on your client's current financial circumstances. Let's say that your client can pay some back each month, but within that 10 years, it's never going to, let's say it's $20 a month. It's not going to hit $6,000, and things could change. In that case, the IRS, we should consider, it's called a partial payment installment agreement. So basically, they'll take the $20 a month. They won't do any further collection actions like levies, but they might reevaluate their financial circumstances down the road to see if your client's ability to pay is increased. Similar to that is a currently not collectible status. That's just saying currently your client can't pay anything. If you can prove that and the IRS agrees, they'll just put a total hold on any collection action, no levies indefinitely. Typically, that'll go for about 2 years or so, could last longer, but eventually the IRS could reevaluate financial circumstances. If they're consistent, then currently not collectible status should remain in effect. If they've changed, then it's possible your client will be asked to pay some money down the road. Just an option. And again, the installment agreement, that's if within the full statute of limitations, your client can pay the liability. You can do it up to 10 years, and that's an option. I'd say it's the last option at this point, but just something to keep in mind, short of having to send a check for a lump sum payment. So that is the presentation. Thank you for attending today. I know this is complicated, and I've tried my best to make it something that somebody has had no experience with, really employment taxes, the trust fund recovery penalty could follow. And as interesting as it can be, hopefully my story did that. But if you have any questions, if it comes up, if you have any questions about the presentation or a potential client or one of your pro bono cases or what have you, this issue here is encountered and you have any questions, just here's my contact information. Shoot me an email, give me a call. Happy to talk about it with you. And that is the presentation.
Great. Well, thank you, Dan. Thanks. And for anybody listening, if you have any questions or comments, please feel free to go ahead and put them in either the Q&A box or the chat box. I don't see any right now, but certainly feel free to do that. I guess I had one question, Dan, in terms of when the IRS is looking for someone to assign this to, can that blame sort of be split amongst other staffs? I think in the last one of the later slides, you said something about a partial assessment as opposed to maybe a
okay. So the way that works is the IRS, through the trust fund recovery penalty investigation, it can make multiple people liable for the same debt, which again, any payments made among any of those individuals, everyone gets credit. But the IRS revenue officer won't determine that you're only liable for a partial debt. However, in appeals can make that determination. So hypothetically, if the full liability here was $5,000, but appeals, they look at what's called hazards of litigation. If you end up in court, what are the odds we lose? And let's say appeals thinks there's a 30% chance appeals actually wins this case. They might say we'll settle for 30% of the proposed trust fund recovery penalty. And that's another decision where, given the facts and circumstances, that might be your best option. It really depends on how confident you are about your facts. But that would be a function of appeals, not the revenue officer.
Okay. All right. We do have one question. I don't know if you're able to see it.
I see that. Yes. So the trust fund recovery penalty can be settled with an offer in compromise. Which typically that's what will happen. And we do this, it's not frequent with our clients, but sometimes our clients, that scary scenario where they make decent money, but end up getting assessed $150,000 for a trust fund recovery penalty. You might decide that the offer in compromise is a good choice, knowing that there's no way they're ever paying back that very large liability. And so if your client can only pay back $5,000, it's a call you make where it's something that settlement is your best course of action. And but yes, that absolutely you get offer and compromise can be trust fund recovery penalty is not barred from that.
So then is that the offer and compromise is after you sort of agreed or accepted that it is your fault?
Well,
or
yes, I wouldn't say at that point you haven't agreed to anything. But if you're out of, so basically I would argue if you've gone through all your administrative remedies and you're not prepared to take this to court, and you know that there's just, you have a very strong offer and compromise. I would say, for lack of a better term, it's a cost benefit analysis. So you could do, and honestly, not to get too complicated here, you're not giving up one by doing the other. So you could do the offer and compromise. If you're successful, case closed. If it fails, you still could arguably pursue a refund claim and a refund suit down the road. So you have to be careful with timing of some of these things, but you can seek different remedies. That's more of a big picture strategy. So you have to make that decision on, where you want to apply those resources.
And then does this follow you anywhere? Like this history of being involved in a trust fund recovery penalty, does that somehow?
So eventually, if you don't do anything about it, a notice of federal tax lien will be filed. And those don't go in credit reports anymore, but you probably don't want people to think that you're responsible for $80,000 of a corporate tax debt. You're not going to see your defenses. You're just going to see you owe a large IRS tax liability. So as far as the implications, the notice of federal tax lien would be the public filing that if you don't address it, that would be your, I don't want to say it's an inevitability, but a very likely outcome. I'm sure to sue the IRS if you don't address it either. The IRS eventually can levy you to collect it. They could send you to a third-party debt collector who can harass you about it. It's not going to go away on its own. So, but the lien is the public notification that you have this tax problem.
Okay. And then there's a second question about the OIC. Can the taxpayer pursue the doubt as to liability OIC after appeals?
So if appeals makes the determination and you don't seek your remedies to fight it at that point, I believe you're barred from a doubt as to liability. I think if you do the doubt as liability offer and compromise, ultimately the outcome is going to be that you had your chance to pursue this in appeals. You had your chance to contest the liability in a further jurisdiction, but you effectively waived that right when you stopped fighting it through there. So I believe, and again, if anyone disagrees, I'm happy to hear the follow-up, but in that case, if you've gone through appeals unsuccessfully and you don't pursue, well, at that point, your only remedy would be the refund suit to contest the liability. But you can do administratively. I mean, you don't have to go right to questions. The administrative claim, which unsuccessful, you could then further parlay into the refund suit, which, again, a refund suit is a great way to fight a liability, and we've had great success doing it. It's just you're in federal court. It's at that point, it's public. You're going through discovery. I mean, it will be a lot of time, but given the circumstances, it's absolutely something you should not shy away from.
Okay, great. Well, thank you. It's a little bit after 1 o'clock, so I think we're going to be ending soon, but I wanted to thank everyone for joining us. And thank you, Dan, for putting this all together. And you've taken a topic that can be kind of complicated and made a nice little story out of it. So thank you for that. And again, everyone, whoops, I think we have one more question. Oh, nope. Was a comment. So thank you. So again, for our volunteers, this recording will be available. We'll try to edit out that little part that we missed, Dan. But we do also have his slides, which I think really tell the story well. So thank you again, Dan. Thank you everyone for joining us, and stay cool.
Thank you guys. Thank you everyone. Thank you, Janice. And again, feel free to reach out with any questions. I'm happy to talk or email. Thank you again.
Thanks, everyone.
Bye.